the ongoing series of Finance for Everyone. Today is the last lecture of the series where we will be talking about money, cash, savings, about managing your own funds and about managing the others' funds. So there is a lot of importance of cash and savings, and they grow your money through investing and pursuing the opportunities for expansion. Now, the standard recommendation which we already talked about for amount of money that you have been saving in an emergency fund is between 3 and 6 months worth your living expenses. So, when you are able to accumulate this kind of money, that means you are ready for your contingency fund. And of course, there is definitely a change in the plan of the way you save money for your contingency funds and the amount which you save. There can be a variation because of the timeline, because of the environmental changes. So, we have to review the future events, and actually the future events and the dynamism around us will be able to completely predict about the money you would be needing in the future. And of course, all these things will be able to help you in taking the informed decisions, the rational decisions and the right kind of decisions which will help in your personal management of the funds. So, we talk about savings, we talk about investments. It's all about accumulating wealth, and these two activities, both savings and investment, they are not interchangeable. There is a risk factor which has to be taken into account, and about the assessment part, and of course the establishing a reserve for unexpected cost, which is also very important, in which you have to set a goal. You have to start with a small amount which you have to keep. You have to put your savings first and you have to keep it separate. So, you have to reassess the situation time and again depending upon the environment, and this kind of a review and updations will be able to help you in having a right amount of money in your bank accounts for the contingency funds. We also talked about the different kind of the saving accounts, in which we talked about the certificate of deposits, which is important, and about creating a budget for your expenses, then about determining your income from the various sources, making a list for your expenses, and you have to establish the priorities in which you are able to spend the money under that distribution part. So, you have to make a fund, you have to make a budget, you have to keep a track of the amount spent, you have to examine the situation on a very regular basis and modify the funds accordingly and modify the budget accordingly. So, now there is a comparison between the different type of savings accounts. Now, when it comes to being reasonable and responsible for one's own financial management, selecting the appropriate saving account is also a very, very important and essential step. And when it comes to putting money away, many people prefer to use the saving account rather than checking accounts, because saving account typically involve less risk and provide a higher rate of return or investments. So, when comparing the different savings account, the interest rates and the fees are two important factors which have to be taken into account. The interest rate and also the other part wherever you are finding it important. So, there is a concept called compounding interest rates, which are also very important method, in which the interest is earned not only on the initial principal amount but also on the previous amount that has been accumulated. So, this has a very potential on the results in a very sizable increase in the savings over time. Then suppose, for example, the total amount is 10,000, which is stashed away in a saving account that offers a 5% annual rate of interest. So, following a passage of one time, you would be able to be awarded an additional rupees 500 in the interest, and the grand total would be 10,500. With the compound interest, however, the 500 rupees in the interest would start earning interest for itself as well. The second year, you would earn the interest only in the initial 10,000 rupees, but also on the accumulated 500 rupees worth the interest for the year above. Now, in the other words, if you earn a total of 15,000 rupees in the interest, assuming that the interest rate stays the same 5%, you will be able to earn an additional rupees 525 in interest over the course of the second year. bringing you grand total of 11,025 rupees. So this method has the potential of result in a sizable increase in the savings over time. And if you kept earning 5% interest on your savings each year and did not make any new deposit or withdrawal, the following is, however, your balance would grow over time. Following 5 years would be rupees 12,762. After 10 years, it would be 16,386 Indian rupees. And following a period of 20 years, it would be 26,533. So after 30 years, it would be 42,933 Indian rupees. So as we can see here, even a relatively minor change in the interest rate can have a significant bearing on the rate at which your savings will accumulate over the courses of period of time. Now, because of this, it is very essential to know some comparison shopping to find the best interest rates and to start saving as early as possible to take advantage of the benefits of the compound interest. And if you're carrying a balance and of course a balance of debt, compound interest can also work against you in a very negative way. For example, the debt incurred through the credit cards frequently comes with a high interest rate that accumulate over time. And when you carry a balance from month to month on your credit card, you are subject to incurring the interest charges, which can quickly add up and make it very difficult to pay off the debts. Now, because of this, it is essential to pay off the debts with the high interest rates as quickly as you possibly can and to avoid carrying a balance whenever it is possible to do so. So, in conclusion, we can say the compound interest is a potential and a potent tool that can really assist you in the growth of your savings over the course of time. However, it can also work against you if you are working and carrying a debt load. You can set yourself up for a long-term financial success by utilizing the compound interest to your advantage and avoiding taking a debt with a high interest rates. Now, let us do some strategies to increase the savings, such as setting the financial goals and automating the savings. One of the most important skill you can have is the ability to manage your own money, as this will help you achieve your financial goals and build the wealth over time. Now, savings more of your income is one of the most important thing you can do with regards to the management of your finances, and there are few strategies that can really assist you in doing so. Now, establish your financial objectives. An essential first step towards increasing your savings is to establish your financial objectives. You can create a clear plan for your much need to save and when you need to save it by defining your goals and then working backwards from there. So, to give you an example, if your goal is rupees about 10 lakhs for a down payment on a house within the next year, you will be able to save INR 8,333 every single month in order to reach that goal. You need to make a budget. Now, making a budget is another essential step in effectively managing your money and growing your savings. So, get started right away. If you keep track of both your income and your expenditure, you'll be able to identify the areas in which you can reduce your spending and thereby increase the amount of money you save. Now, if you currently spend rupees, about 5,000 per month on eating out, for instance, you could cut down that to INR 3,000, which would result in a saving of rupees 2,000 per month. Then is your automate your savings. So, if you want to guarantee that you are consistently setting the money aside, one effective strategy is to automate your savings. You're able to arrange your funds to be able to automatically from your checking account to your saving account on a recurring basis, such as once in a month or after each pay period. If you pay away the INR 10,000 every month, for example, you can program an automatic transfer of INR 5,000 every 2 weeks into your bank account. So consider opening a high yield saving account if you want to get most out of your savings account. So you would think about opening a high yield saving account. The interest rate offered by these interests are typically higher than those offered by the conventional saving account. As a result, your savings can potentially grow at more rapid rates over time. So in general, there are many different approaches that you can take to boost your savings and improve your ability to effectively manage your own money. You can build a strong foundation for your financial structure and the future by establishing the financial goals, developing a budget, automating your savings, and giving some thought to high yield saving account. Now all of these should be done. Let us now talk about the problems that can arise when excessive amount of cash is held on hand while insufficient funds are invested. Even though it's very critical and crucial to be prepared for unexpected expenses and immediate requirements, keeping an excessive amount of cash in hand can actually be very harmful to your financial well-being. Now, in a similar vein, if you do not invest a sufficient amount of your money, this will also going to put a long-term financial well-being at risk. So, keeping too much cash in hand and not investing it enough comes with a number of risks, including the following. You put yourself at risk of being negatively affected by inflation, and if you keep a significant amount of cash in hand for an extended period of time, since inflation has the effect of lowering the purchasing power of money over time. So this indicates that the value of your savings may actually decrease as time goes on as a result of inflation. If you don't put your money into investments, you run the risk of missing out on potential returns on those investments. So for example, if you had kept rupees 10 lakhs in cash in 2010, rather than investing it in a diversified stock portfolio index market, you would have missed out on the potential returns over 250% by 2023. So this is because of the funds would have grown in value over the course of the next 5 years. Next is your opportunity cost. So if you keep your cash on hand rather than using it for other purposes, such as paying off the debts, making a down payment on house, or investing in your education or business, you run the risk of missing out on potential opportunities to use the money for those other purposes. You put yourself at risk for theft or loss whenever you keep a significant amount of cash in hand because of the possibility that it would be taken from you or the loss. So if someone steals or loses your cash, there is a chance that you won't be able to get it back. Now, listed below are some of the examples that illustrate the dangers associated with maintaining an excessive amount of cash in hand. So if you had kept 10,000 rupees in cash in 2010 rather than investing in diversified portfolio, so this would not be going on for a lucrative returns by 2022 and 2023. So if you keep an excessive amount of cash on hand in case of unexpected expenses, you would run the risk of missing out on potential returns from other kind of investments. For example, rupees 5 lakh in cash rather than investing in a low risk mutual funds, for instance, you would be passing up of the potential returns of around 20,000 per year. So this is because you are not taking into account the risk with your money. So overall, it is very important to make sure that you do not keep too much cash in hand and miss out the potential investment returns. While it is very important to have cash for emergencies and short-term needs, so it is also very important to make sure that you do not keep too much cash and you can build a long-term wealth and reduce the risk associated with keeping too much cash by investing your money in the way that makes the most sense to you. So, there are different type of the saving schemes which are given by the Indian government. The first is the Public Provident Fund. So, this is a long-term saving schemes offered by the Indian government. The individuals can open a PPF account at any kind of a post office or designated bank branch. So, this current interest rate of the PPF is about 7.1% per annum. When you talk about the National Savings Certificate, NSC, so this is a fixed income saving scheme offered by Indian government. The National Savings Scheme can be purchased from any the post office in India, and the rate is about 6.8% per annum. Then we have Sukanya Samriddhi Yojana, SSY. So this is a saving scheme specially designed for the girl child. The parents can open an SSY account for their daughters before she turns 10 years of age, and the current interest rate is 7.6% per annum. Then we have a senior citizen saving schemes. So this is a scheme for the senior citizens above 60 years of age, and the current interest rate is 7.4% per annum. Then we have Kisan Vikas Patra, which we call it as KYPs. So this is a saving scheme designed for the farmers. The Kisan Vikas Patra can be purchased from any post office in India, and the rate is 6.9% per annum. Then we have the Post Office Monthly Income Scheme, which we call it as POMIS. So this is a saving scheme offered by Indian Post Office. Individuals can open a POMIS account at any post office in India. The current interest rate for POMIS is 6.6% per annum. So these are some of the very popular schemes in India offered by the government. Individuals can choose the schemes that best suit their financial goals and investment needs. Now let us now talk about a very pertinent topic called managing other people's money. So managing others people implies making the financial decisions for them. Investments, bills and purchases are examples. Managing a family member, friend or a client's funds requires diligence, care and integrity. The credit and the debits are very crucial to managing the money. Debit is spending money while credit is borrowing. Managing someone else's money requires knowing their credit score, using the credit cards and the loans very wisely. So this involves paying on time, not taking new debts, avoiding high interest loans and the credit cards. So the debit cards and the credit purchases are safer and more controlled, tracking expenses and the borrowings. Only on necessitates, while saving and investment is very crucial. Understanding the credit and the debit is very vital for the prudent money management and protecting others' finances. So let us now do the key credit concepts of the various types. The credit lets people and the corporations borrow money and pay it back with interest. Then we have the credit scores and the histories indicating a borrower's capacity to repay the loans on time. Thus, they are used to manage other people's money. Then we have the credit includes the credit cards, the personal loans and the mortgages. Revolving the credit cards allowing the borrowers to make purchases up to a specific limit and the payback time borrowed amount plus the interest each month. Then we have the personal loans are the installment credits that allow the borrowers to borrow a certain amount and repay it in a very predictable payments over a set period of time, usually with a fixed interest rates. Then we have the mortgages. They are installment loans used to pay a property and the borrower's money from the lender and repay it with the interest over defined period of time. Then to keep a decent credit score, use the credit sensibly and pay on time. Then we have a poor credit scores can make it harder to get the credit and lead to high interest rates or the loan denials. Then we have the credit scores. They are the numerical representation of a person's credit worthiness and are used by the financial institutions and the lenders to assess their financial risk when lending the money or extending the credit. A high credit score indicates a lower risk, while a lower credit score indicates a higher risk. A higher credit score indicates a lower risk, while lower credit indicates a higher risk. Here are some of the key important points on how the credit scores are calculated and why they are important in managing other people's money. The first is your payment history. The most crucial factor in determining a credit score is a person's payment history. This includes whether or not they are paid their bills in time or not, how frequently they have missed the payments, how many days past due they were. The payment history accounts for a period of 35% of the credit score calculations. Next is your credit utilization. The credit utilization is the amount of credit a person has used compared to their total credit limits. The higher utilization rate can negatively impact the credit scores. The credit utilization accounts for around 30% of the credit score calculations. The length of the credit history. A longer credit history generally indicates more stability and a lower risk of default. So this risk factor accounts for 15% of the credit score calculations. The length of the credit history. A long credit history generally indicates more stability and a lower risk of default. So this factor accounts for around 15% on the credit scores calculations. Next we have is a credit mix. Having a mix of different type of credit such as credit cards, auto loans, mortgages can positively impact the credit scores. So the credit mix accounts for around 10% of the credit score calculations. Next we have is a new credit. Opening multiple new credit accounts in a short period of time can negatively impact the credit scores. So this factor accounts for around 10% of the credit scores calculations. The credit scores are very important in managing other people's money because they are impacting a person's ability to obtain the credit or the loans. A low credit score may result in the higher interest rates or even denial of the credits, while a high credit score may result in lower interest rates and more favorable loan terms. So therefore, it is very crucial to maintain a good credit score to have a better financial opportunities and access to the credit at more favorable terms. As a financial manager, it is very essential to monitor and manage the credit scores of the clients to help them achieve their financial goals and also the objectives. The credit management is very crucial to the personal finance. Now, there are some strategies for the credit management. The first is late payment might hurt your credit score. Keep your credit utilization low. The credit utilization is the percentage of the available credit you are using. The credit utilization should be below 30% to retain a decent grade. Don't over apply for credit. Applying for too many lines of credit in a short time may signal the financial difficulty to the lenders. Monitor your credit report. Reviewing your credit report periodically might help you spot inaccuracies with the fraud. You can get a free credit report for each of your 3 major credit reporting agencies once in a year. So if you have no credit history or a low credit history, a secured credit card might help you build the credit. Your credit might be and will be able to get your deposits. So keep the previous account open. Your credit score depends on how long you have had the credit. Instead of cancelling an outdated credit card, leave it open. Pay down the debt. Paying down the debt might increase your credit utilization ratio and the credit scores. So it takes time to improve your credit scores. You can progressively create a strong credit history and increase your credit card scores by using the responsible credit practices. Paying the bills on time, keeping the credit utilization low, being cautious about applying for the credits, monitoring your credit report, and considering your secured credit cards, keeping the old accounts open, paying down the credit, and being patient about all the parts of the responsible credit management. You can preserve good credits and enhance your credit card score by the following tips. The first out of it is a debit. A debit transaction removes the funds from an account. It subtracts from an account, unlike a credit card. Bank and finance use the debit to manage your other people's money. Checking account are frequent debit methods. A checking account lets people deposit with the withdraw money. So, this is how it is deducted when the funds are withdrawn. So, the debit cards are another form, and they are letting people buy the things and withdraw the money from their checking accounts. So, the debit card purchases and the cash withdrawals immediately debits the account. And of course, debit card don't impose the interest or carry a balance fees, and they may not safeguard against the fraud or unauthorized transactions as well as the credit cards. Then about managing your debt. You have to manage your debt, which helps in avoiding the penalties, out of which the first is budgeting. Budgeting is a first step in the debit management. Set a notification. Many banks offer alerts to assist you, prevent overdraft, set up the alerts for the low balance or the significant in transactions. Then you have to avoid the overdraft fees. They can add up rapidly. Avoid overdraft fees by disabling the overdraft protection or linking your debit card to a saving account or the credit cards. So keep track of your account to minimizing of the overspending. Then about use the debit card responsibly, and of course manage your points. So overall, like in case of groceries, etc. So the debit management needs discipline, financial awareness, budgeting, setting alarms, avoiding overdraft fees, using the debit cards properly. You may manage your debit and maintain your this thing, etc. in a very nice way. So if all these things are taken into consideration, financial planning can be done in a stupendous good way, which will help in achieving your financial goals. And of course, once you're clear about your financial goals and you know how to do it. So in summary, we can say financial planning involves assessing one's own current financial situation, setting a realistic financial goals, creating a plan to achieve those goals, and regularly monitoring and adjusting the plan as it is needed. Thank you so much.